Good afternoon, friends. Welcome to our annual financial results call for fiscal 18. Just as a summary, I'll just read out the financial metrics that we have achieved for this particular year. Not fully representative of on a comparison basis to the previous fiscal year because of the transaction that we did in December 2017. So broadly, we achieved a consolidated revenue for the year at about 7,663 crores. This has, of course, partial consolidation till December for DCCDL, and in the fourth quarter, which was the first quarter where DCCDL is now treated as a JV in our accounting, that revenues have been carved out of the results. EBITDA stood at about 3,334 crores and a consolidated PAT about 4,476 crores, which included the one-time exceptional gain on the fair valuation of DLF's residual stake in DCCDL. The EPS, of course, is 25 odd rupees, and dividend that we have recommended to the shareholders for approval for the full year is at 2 rupees per share. If we were to look on a quarterly basis, which is far more representative because as DCCDL is now carved out, the consolidated revenue of DLF Ltd is at 1,846 crores and EBITDA at 454 crores with a consolidated profit after tax of about 244 crores. EPS of about 1.39 rupees per share. The key highlights for this quarter is something which I would like to tell more is basically if you look at our sales momentum has picked up during the quarter. In the last quarter, we did net bookings of about 480 crores. But in this quarter, our net bookings have jumped up to 750 odd crores. The gross bookings, which is actually a more important number for you to track, is about 950 crores because the 200 crores is predominantly upgradation of product in our space. So unlike most of the other players in the real estate space, we report both the gross and net bookings, and the difference between the two is predominantly the upgradation that we offer to our customers. So we are achieving actually a number of gross sales of about almost 1,000 odd crores during the quarter. However, as always, we would like at this stage to give a guidance of a steady state on a quarter because this is a lumpy business on a steady state basis of bookings of about 2,000 to 2,500 crores on a quarterly basis. As quarters pass by, obviously, we will keep on guiding the markets as to what the ground level conditions are which impact our sales. The operating cash deficit ex-dividend in this quarter has fallen by about 500 crores. It was a negative 1,000 odd crores in the previous quarter. This is ex-dividend what I'm representing to you. So we have started seeing benefits of additional sales, collections, and interest cost savings in this quarter. And we are quite confident that in the next few quarters, this number shall continue to decline. The net debt at the end of this fiscal year stood at about 6,265 crores. Between end December and this quarter, we have paid down about 7,000 odd crores of debt from the infusion of 9,000 odd crores from the promoters. During this quarter, we also did a bid for an HICDC land for commercial development. It's a development similar to our Phase 5 development, which we had done, which was christened as Horizon Center in Phase 5. And at this stage, we are in the process of paying for the land and also in parallel seeking an equity partner. This land parcel was very strategic for us, hence we could not really ignore. It was a land parcel which was just across the highway on our Cyber City campus, and hence, we looked at much more strategically in acquisition of this land parcel. But going forward, again, I would like to guide the markets is that we are not in a phase of acquiring land parcels. It will be smaller, opportunistic ones, which basically only enhance the existing land parcel that we have, but we are not in the lookout for any high-value land parcels at this particular stage of our plan. Coming to the net debt position, what I would like to highlight is that the number which stands at about 6,265 crores at end of March is primarily will be achieved just merely by the capital infusion, which is already committed both by the partners, by the promoters of their balance infusion of about 2,250 odd crores, which should happen end of December this year or early Jan, and the QIP that we have to do. So my message to our friends is that this number is already covered by the capital action that we have to take over the next few months itself. The balance, if you look at it, the cash collections have improved. Our bookings that we had done in Q3 have started resulting in cash flows in Q4. I also want to highlight something over here is that now we are selling all completed properties, and hence my sales to collection cycle has actually compressed. So, in 6 to 9 months, we start to achieve almost 100% of the cash that we need to receive on that sale. So unlike in most of the other cases where it is a 2.5, 3 or 4 year cycle to receive the monies as you construct here, the hard work of construction and the pain of construction expenses has already been incurred, and mostly now it is booking sales and collections as such. This momentum has picked up in Q4, which will of course result in enhanced collections in this current fiscal year. And as we see also in the month of April, the momentum continues on the sales side of it. And of course, we look forward to guiding the markets in the Jan quarter as to how we really perform on that. On the DCCDL side of the business, which is the rental business, which now we only own 67% of the shares, for the quarter fiscal 18, we achieved a consolidated income of about 1,243 crores, and for the full year it is about 4,930 odd crores. And here I want to highlight is that in this total income, there is an interest income that they derive from DLF, which is about 225 odd crores on the payables which is there. So you need to factor that into account. Obviously, once the settlement of that payable happens, the interest cost of DLF will go down. My income from those yielding properties, which will also go down, but so would also the income of interest income of DCCDL will go down, while their rentals income will go up. So broadly, I think purely from a DLF development side of the story is that the interest income that you see of about 500 odd crores, it has an element which is associated to a related party of about 225 odd crores over there. On the gross leasing side, we've done quite well. We've done almost 5.5 odd million square feet of gross leasing and a net leasing of about 1 million odd square feet across the country. Again, next few slides are basically on our differentiated business model. I think we have spoken at length about it, so I will not delve deeper into it. But I think the strong message that I would like to conclude my opening remarks is that the sales momentum continues to pick up momentum. It is reflected in almost 950 odd crores of gross sales in Q4. Our collections are bound to improve as the sales, of course, improves. Our construction spend will taper off as projects get delivered during this fiscal year itself. And once the capital action happens, the interest burn that is there on the current debt levels will also go off our books, and free cash will emanate within this fiscal year. So broadly, that's what my guidance to the market and to analysts is. We're open to questions that you may have on our accounts or on our strategy or outlook to the real estate markets. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset mode while asking your question. Anyone who wishes to ask a question, please press star and 1 at this time. The first question is from the line of Tarak Kumar from JP Morgan. Please go ahead.
Hi team. So my first question is essentially on your margins. So why were the margins so low during this quarter, especially when crest sales would have come through in this quarter for recognition?
Sort of two pieces. One is that yes, part of the crest collections of the crest sales have been recognized in the first 50 odd apartments that got booked in November and December would have hit recognition. But B, when you look at the margins, actually, I mean, I think as you have analyzed yourself, I'm sure, in the last 3 or 4 quarters, given the fact that some of our heritage projects were at the end of the construction, actually our DevCo business margins were under pressure. And the same sort of thing has continued this quarter. We expect this to begin reversing, significantly from Q1 onwards, frankly, because we know that in the unsold inventory, we have almost a 40 to 50% embedded EBITDA margin that is there. But I think clearly since this was the first transition quarter, it hasn't come through fully. We expect to see that honestly going forward, hopefully from Q1 onwards, when both the residual crest and some of the camellias that were relaunched from November, those margins begin flowing into the business.
Okay, and this would have got the Manesar land impact also in this month.
This also has the Manesar land impact, yeah, absolutely.
Okay, and sir, the second question is on the cash flow. So basically, your debt has gone up by 750 crores quarter over quarter, and the dividend impact is 250 crores. So the net free cash is essentially 500 crore negative. And for you to guide to a zero net debt by March 19, and if you kind of assume that this 500 crore run rate sustains for the next 2 quarters, basically assumes that by second half of 19, you should be generating close to about 1,500 crores of free cash flow. Is that something which you think is possible, or?
So sort of two things. A, of this 500 crores deficit, about 225, 250 crores is the interest outgo, which we expect should come down to almost a zero or a near zero number by end of March. So that will be half of the problem. And the balance half, you are right, should come in through improved sales collections, frankly. I mean, if you look at our historical receivables and historical construction spends, our receivables are already higher than the residual construction spend, plus the new sales that we keep on doing should hopefully, yield the cash positive. So honestly, I mean, this is the first quarter, frankly, when you had like a 500 crores the cash deficit down from, as you know, far higher numbers. So I think let's keep a strong watch at least for this quarter. But we feel right now pretty good given the direction of both sales and the residual part of the capital raise, etc., that by the year you should see a declining trend definitely from June onwards. And B, hopefully by the time we hit Q4, we should be pretty near a cash neutrality on this piece.
Okay, sir. And just one final question, sir. The rental growth, I mean, if you look at DC serial 4Q17 to 4Q18, that growth number is just 3%. So I'm just wondering.
Yeah, I saw your also, 1 sec. Because,
what will be the core NOI growth in DC serial?
What he's asking.
So the normalized growth what we have in the rental business is in the range of 5 to 7%. But given that you have an Ind AS in which you have to do a straight lining of the rental income, so the more leasing what you do, and you have to amortize for the rent-free period. So this ups and downs on the Ind AS straight lining is what creates an abnormality on quarter basis. But on a normalized basis, the growth is 5% to 7%.
Okay, so this 25 crores is now the NOI we should work with, right, on this?
And also, Saurabh, whilst you are on this particular subject, what I would again like to highlight is that on a long-term basis, our growth in DCCDL is expected to be northward of 14 to 15% CAGR. That is what has been seen when we extrapolate all our contracted leases over a period of time. This also includes many of the rent reversions that are coming over the next 36 to 58 months. And if we were to induct more assets into this entity, this number will even gravitate above than what I've guided. So I think that is something which you should keep in mind. On a Q1Q basis or annual basis, of course, because of Ind AS adjustments and straight linings, these numbers can be, of course, explained.
Okay, I have a few more, but I'll come back in the queue. Thank you.
Thank you. The next question is from the line of Kunal Lakhan from Axis Capital. Please go ahead.
Hi, good evening. We have highlighted in a presentation on slide 10 that the near-term project pipeline is about 11 to 12 million square feet. Just wanted to understand, what will be the capex on this pipeline and how it will get staggered over the next 3 to 5 years.
So the first project is the joint venture that we have with GIC in Delhi. On the first 2 million square feet of it, the commencement of construction is happening. So obviously, we will bring it to the market at a later date, given in line with our philosophy of bringing to the market once we are reasonably certain of the completion customer commitment that we can make. I don't have the numbers offhand, but we believe that the cost of construction here should be in the range of 6,000 rupees a square foot against the anticipated launch price of 20,000, which should hopefully only increase and strengthen with time. The second one, honestly, the HIDC piece, I think we're still about a year away from, or maybe at least 8 to 10 months away from the actual launch of it in that sense. So I think we can take a closer look at the construction costing then, but we again expect this construction costing to be broadly in the range of 5,000 rupees a square foot.
Sure. And the last one?
The third one is IT.
The third one is IT. There the construction costing should be 3 to 3.5, or maybe definitely south of 3,500 rupees a square foot, more like 3.
Have we commenced construction here?
So, the third one, actually, there's a 35-acre land parcel that we have, of which 18-odd acres is already done and commissioned, and the balance, this is the residual construction in that entire phase, which I think we will commence in the next few months.
Sure, that's helpful. My second question was on, can you break down the cash flows, cash inflows, and cash outflows for this quarter?
I think we'll have to do that offline as to how you would like it to be broken down. I think Rajiv could do it offline.
Sure, and another related question is basically what is the balance outflow for completing our ongoing projects now?
So ongoing projects should be in the range of about 2,500 crores is the balance construction spend that is there.
It includes some of the capex also. So it's not all on the projects. About 500 crores is on capex.
It includes some of the capex also, which we are creating the investment properties.
All right. Thanks so much. I'll come back in the queue.
Thank you. The next question is from the line of Atul Tiwari from Citigroup. Please go ahead.
Yes, sir. Thanks a lot. Sir, why was other income so high in the fourth quarter? What drove this?
So the other income is basically higher, because we had a JV earlier on a JV that long time back we had set up with Unitech, which we eventually took control of. So it had been provided for earlier, but it had money, so some money got written back there. There were some of the earlier provisions that had been created earlier, which on subsequent, money coming back from those investments actually, again went there. And then there's a large chunk of it, which is on account of a couple of sale properties which were in our books as fixed assets, small 20-25 crore each sort of properties, which got sold. So whenever a fixed asset gets sold, it gets reported in other income instead of getting reported as sales. Then there's a lot of interest income on account of some tax refunds that we've got in the last quarter and some compensations that we have got on land acquired by the Haryana government. So there's a detailed breakup. It's a one-time spike, but there's a detailed breakup, which if you want, offline, Rajiv Goel can give you. But it's a combination of all of these things. So some provisions back, some compensation received, some interest received, one this joint venture with cash in it coming under our control. It's a combination of these 4 or 5 things.
Okay, sir. And sir, if I look at your fourth quarter, EBITDA excluding other income, it's a negative number, so in response to a previous question, you said that your current inventory had 50-60% embedded EBITDA margin. So does it mean that over next 1-2 quarters, this negative EBITDA can shift to 50-60% EBITDA margin in the P&L?
So 2 points. One, if you were to compare, as an example, Q3 of last year, Q3 18, which had the Cyber City embedded, and if you were to use your formula of excluding other income, the EBITDA was about 700 crores, and the Cyber City EBITDA was about 780 crores. So it was a negative 80 on the DevCo business. So the fact is, the DevCo business, you are right, because of the high overhead structure that we had and some of the heritage construction costs on projects with little margins is unfortunately at hopefully the fag end of this compressed EBITDA cycle. We expect that with the increase in sales on one hand, the ending of construction on some of these very, very old projects on the other, and hopefully a far more focused drive on cutting our overheads on the third. This should come back. The fact is, EBITDA will never be 50% because you still have SG&A expenses which will have to be deducted from the number that I mentioned. But the SG&A expenses over time should be a lesser number. So the EBITDA should go up. However, since this was the first quarter net of cyber, right, but so one more quarter we'll refrain from giving an EBITDA guidance because we all honestly ourselves need to understand the way the mechanics work. See, and this is honestly something which I do want to, let all the analysts know, and I'm honestly, we are surprised that it has not had a bigger discussion in any of the other real estate quarter ends that we have seen, is that from effective 1/4/18, at least as the law stands right now, a new revenue standard could come in, which could dramatically alter EBITDAs for most real estate players if they are true to the law. Hence, I think that let's wait for the June quarter to fully understand where the new accounting standard is going to be and how do the EBITDAs basically play in going forward.
So this is the Ind AS
115, which has been notified now.
Okay, sir. And sir, my last question is again on, say, if you look at past 6 months, second half of FY18 broadly cash flow, so promoters infused 90 billion rupees, but DLF plus DCCDL's consolidated net debt versus what it was at 2Q FY18 end has come down only by about 43 billion rupees. So there is a large gap of about 45 billion. So, I mean, if you could somehow reconcile where, apart from your normal, operating cash loss in 2 quarters, which would have been about 10-15 billion rupees, how should we reconcile it?
If you were to combine the two, you'll have to knock off about 1,600 crores with Cyber City used for buying back the promoter's equity, because that will be a wash here. But yes, the 73 came down to 43, which is a combination of the operating deficits across the 2 quarters, the net dividend payouts, the additional monies that Cyber City has paid to the government of Haryana for TOD, which again is a number north of 500 crores at least in that sense, and the payments that we have made for some of the CapExes like the HSIDC. So if you want, we can give you, I think it's already there in detail in the Q3 presentation and the Q4 presentation, but if you want to serve the second half, we can sum it up and ensure that.
Okay, thank you.
So the number is not 9, it's actually 9 on the DLF side, but on the console side, it's actually 7.4 that you begin with.
Yeah.
Thank you. I would request Mr. Tiwari to come back in queue for follow-up question. We would also request participants to limit your question to one at a time. We'll move to our next question, which is from the line of Puneet Gulati from HSBC. Please go ahead.
Yeah, thank you so much for the opportunity. Just two things here. When you said 500 crore deficit, does that assume the construction cost that you would start incurring on the new projects that you are launching?
Yes, that includes that. Some of the costs have started to happen, especially in Midtown. Some of the costs have started to happen.
Okay. So in no case the deficit can be more than 500 crores, right, in terms of construction cost? It's a per quarter number, right?
That's what our outlook is. What we are saying is that it will be on a declining trend. There are no guarantees in this world, but what we are guiding is that it will be on a declining trend.
Of course. And secondly, when you talked about 14% rental growth for DCCDL, does that also incorporate rents or a new construction addition, or is it normal just rental reversions which will drive that growth?
So what I had indicated is that normal growth with rent reversions and some of the properties which are now coming for rentals. For example, there is Cyber Park, which is going to get rented out, which is already pre-leased, half pre-leased, but eventually the rents will begin over there. This is a number that we look at it. If we were to add this to the new developments that Cyber itself would be doing, some of the new assets which Cyber will buy from DLF, if I were to include all those and the new developments that we propose to do there, this number will be, of course, trending higher than the 14-15% that I was telling you about.
Okay. And is it possible to give some sense on what would that growth be if you exclude these two things, then probably just incorporate normal growth and rental reversions?
Normal growth, rental reversions about 7 to 9 odd %.
Okay. That's good. That's all from my side. Yeah.
Thank you. The next question from the line of Samir Baisiwala from Morgan Stanley. Please go ahead.
Yeah, thank you so much. The first question is on Ind AS 115. What's the big item over here? Is it 100% recognition method? Is that what's driving it?
It's close to that, Samir. So, what it states is that you should recognize revenue once all risks and rewards have been passed on to the consumer. Now, whether that is conveyancing, whether that is possession, honestly, those are the sort of nuances that one needs to agree with the auditors. B, as you know, that there is currently a degree of industry lobbying going on against this. But frankly, given the way the trend across the world is, even if there is a 1 or 2 years deferment, which we don't know whether there will be or not, I think clearly that is the sign of things to come, because that is what virtually globally companies across the world seem to have embraced now. But again, so hence we are saying that clearly the way it's notified right now, when we close the June accounts, we will have to, take the appropriate adjustments in 31st March opening and restate the June numbers. So hence we have said that, a lot of things like EBITDA guidance and all, if I give you an EBITDA guidance today, honestly, in 45 days it could turn on its head, frankly, if the 115 comes in. Hopefully for the positive, but it will be for the positive, let me put it that way, but we don't want to guide at this stage. Yes.
Okay, but I would have guessed that India is quite different from the world where the construction cycle is much shorter and the sale begins after the roof is cast, so the sale cycle is even shorter. So 100% recognition makes far more sense versus our 4 to 5 years.
I'm sure those are the sort of arguments that the industry is taking. But frankly, till it is notified and reversed, let's see. Also, as you know, frankly, the accounting standards, approving authorities, etc., are in a stage of transition. So I think some of that will also weigh in on this entire decisioning. So let's see. Hopefully, in 45 days from now, latest, we should all of us should know where the industry stands. One thing we are clear is if the law stands as it is today, we will not take the fancy route through getting legal opinions, etc., to support that our current contracts support this, so we will clearly take the right view which is that the way currently our contracts, in fact, if I may be brave enough to say the industry contracts are, the risk and reward actually gets transitioned at the earliest when full payment is received and possession handed over.
Okay, and the second question is on HSIIDC land parcel. When do you think you will start? I assume this is on a sale model. And if so, then at what point of 4 years of development will you start the sale process over there?
So I think here, as we stated in our presentation, we are in dialogue with a partner over there, and I think our sales would start much earlier than what our stated policy is of fully completed. So, but I think we'll be able to guide you once we formalize the contracts with them.
Okay, so it's a little important, but so would it be like 1 year before completion or even much earlier than that?
So, once the project is closer to, let's say, applying for OC or something like that, is, I would say, a better metric to look at rather than after OC. So, it is basically, where there are not much changes that are involved or can be done to a project.
And you are reasonably definitive about the timeline of delivery. Correct.
Okay. Just one more from my side. It looks like intercompany payable has gone down from 9,300 to 8,300 crores.
Actually, 8,300 looks better than 9,300, but in all fairness, it's just been reclassified correctly. 93 includes 8,300 of receivables, and included certain DL contractual advances, which are a normal part of business, frankly. So this is what we have sort of stated here. As we have said, I think is excluding normal business advances. The total number continues to be in the range of 93, Sameer.
Okay, got it. Yeah, thank you.
So, just to again highlight, the business advances get neutralized when as the property for DAL is getting really delivered. Okay, so like you would have seen in Q4, a portion of the Chennai property has been delivered. So that gets washed out, and whereas this 8,300 is a totally separate and not related to any contract that is existent today. We are currently, of course, in dialogue with GIC, and hopefully, I think in short period of time, we will receive a landing on that. Yeah.
Oh, got it. Thank you.
Thank you. The next question is from the line of Rafael Fu from Target Asset Management. Please go ahead.
Hello. Hi, sir. Hi. I noticed that this quarter, your land bank has come down by about 13 million square feet of developer land in Bangalore. Maybe can you just share what happened around that?
Yeah, this is a very old land bank, which was, I think, bought about 40 or 50 years back. So it's not something which is new, was held at historical value also in our books. It's a suburban land bank, little distant from Bangalore, where a township at some point of time, a township was really planned. This is where we have right now contracted to exit that land parcel with another developer. And hence, from representation perspective, because we have received a small advance, a token advance towards this particular transaction, we have revised our land resource. Hello?
Mr. Raphael, do you have any other questions?
I think there's a cross connection here.
Yes, sir. We seem to have lost his line. So we'll move to the next question in the meanwhile. The next question is from the line of Saurabh Kumar from JP Morgan. Please go ahead.
So thank you for taking the follow-up. So just on the sales, Saurabh, you mentioned you've done more than 1,000 crores this quarter. Most of it seems to be coming from Crest, it seems, and I'm guessing now Crest will be 75-80% sold out. So just in terms of how you're thinking about improving the velocity at Camellias and even your rest of Gurgaon and other India parcels, and how should we think about it, that this momentum can diversify away from Crest?
Actually, Saurabh, you'll be delighted to know that of the 950, only 350 is Crest.
Oh, all right. For the quarter? Wow. Okay. And how much is
Camellias? Able to surprise you. 230 is actually Camellias. 100 broadly is miscellaneous rest of Gurgaon projects. And honestly, about 235 is non-Gurgaon. So actually, we are seeing some degree of rebound on a national basis, frankly. And again, just as a caution, this is the gross sale. Our net number was 750, as Saurabh mentioned earlier.
And a gross number was 950.
Across the 950, crest is only about 35%.
35%. Okay. Okay. And how much will be the run rate in Camellias now, like on a monthly basis? 2 units a month or?
No, Saurabh, I would not put any rated kind of guidance on that. If sometimes it happens, you get 10 of them and sometimes you get only 1 year. So I would not put it that way. I think what we should put is, and I think what should be heartening for you to note, and it is heartening for us to also notice that it is across geographies, and hence would rather give a guidance to a sales number of 2,000 to 2,500 crores on a steady state basis, rather than on a net steady state basis, rather than giving you on a project wise basis.
Okay. And so just on this new Gurgaon parcel, so if you kind of like analyze your return on capital, and your net worth will cross 40,000 crores in fiscal 19. So most of the depression in return on capital, at least a large part of it, seems to be coming from your new Gurgaon asset. And how you're thinking about it? I mean, what's your plan for liquidating? Because most of your long-dated land bank essentially lies out there only.
Well, you're right. I mean, I really can't do much about it because it is a long-term asset that I have, whereas which is not marked to the market as such. I wish we had the IFRS standards where I could revalue the land, and hence my return on net worth would have been much more healthier. So at this stage, we are only in the process of doing, at least from guidance today that I have, is one commercial project in New Gurgaon, a new one which will be breaking ground. Other than that, it will be only, finishing off our sales on the existing projects where most of the completions other than Ultima have really happened. So it's good food for thought over here, but I think unfortunately, given the long-term nature of this land, at least from accounting and book perspective, it will be a little depressed return on net worth. Yeah.
The good news, which again will hopefully have a bearing with a lag, Saurabh, is that clearly the infrastructure there has improved. People have begun shifting there. So I think in our garden city itself, close to, I think, about 1,000 odd families have shifted. Hopefully the toll should go away, pretty shortly, which improves the access to that entire area. But again, there is an oversupply of a lot of developers there, so which is leading to at least suppressed pricing in the secondary market until that issue sort of fully shapes out. From an economic standpoint, especially in residential, we will have to sort of, battle it out.
Okay. And so just one last question on this HSITC development. Is there any reason why this should be in DLF and not part of the DCCDL joint venture? I'm just simply asking because DCCDL, it seems, has a free cash flow and also the mandate to develop the development, and especially it's going to be a Horizon Center style of development. So why should DLF be doing this, and why should you not be doing this under a joint venture?
It's purely from resolving the conflicts of interest. So DLF is, as we have stated over the last 2.5 years, is going to be a development company, and DCCDL will be of course a rental company, investment property company, but yes, they'll also develop their own products there. This negative free cash is a very short-term phenomena, maybe another 2 odd quarters, and I think that question will get addressed at that particular point of time. Our intention is to develop and sell, not develop and lease in this particular property, whereas in case of DCCDL, their teams only develop and lease. So this conflict of interest between two entities is very important to be resolved and kept at bay with each other.
Okay. Thank you. Thank you, guys. Have a good evening. Bye.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is from the line of Ritvik Sheth from Deep Finance. Please go ahead.
Hi, good evening. So a couple of questions. First on the DCCDL numbers, if I strip out the other income, then PBT is down almost 30% for the year. So because of finance costs. So how do we look at, because say 12 or 18 months down the line, other income will be significantly lower, right?
You can't eliminate other income here without the interest expense, because a large chunk of the other income is actually monies borrowed from the banks and on lent to DLF. So once those monies get repaid, you are right, the other income will disappear, but it will be replaced by the actual rental of hopefully rent generating assets. So the balance sheet of that, except moving from other income to actually rents and other receipts, it will not change.
Okay, so the interest income will reduce, but we'll have some rent bearing assets coming in the DCCDL from DLF. Is that right?
That is what we are working towards.
Okay, fair enough. And what explains the higher finance cost? It's almost about 20% in DCCDL.
2,951.
On slide 22 of our presentation.
Yeah. Finance cost is 394.
No, for the full year.
141,1683. Okay. The gross debt has gone up, as is the if you look at other income, that jumped from 562 to 1006.
Right. Yeah.
So they borrowed more, but they also then borrowing to a large degree to on-lend to DLF in the first half of the last year, which is the reason why both these numbers have gone up.
Okay.
And this anomaly, if you will get once the entire squaring off of accounts between DLF.
That will take 12 to 18 months, right?
And it will not be income dilutive to Cyber City, because Cyber City will actually substitute rental income will substitute interest income with actual rental income.
Fair enough. Okay. And so what is the timeline for our QIP?
Well, I think we will of course guide the markets appropriately when we plan to do the QIP. At this stage, given the volatility that is there, both due to high oil and rupee depreciation, I think we rather wait and watch the timing of the QIP as such. The second aspect, which is far more important than even the markets, is that today the uncertainty or representation under the Ind AS 115 is still out there. Our preference would be to get a better sense so that we are able to give the right representations both in our investor meetings and also in our documents for the QIP. So it's a little early stage. I think let the things settle down from a regulatory perspective also.
Thank you. I would request Mr. Shea to come back in queue for follow-up question. We'll move to our next question, which is from the line of Sameer Baisiwala from Morgan Stanley. Please go ahead.
Hi, thanks for the follow-on. On your land bank slide, looks like there's a 13 million square feet reduction, I think largely in Bangalore.
Yeah, Sameer, I think you were not on the call then. This was a historical land bank bought maybe about 40-50 years back in DLF, and it is a suburban land bank for a township development which is a little distant from Bangalore.
So never licensed.
Which was never licensed, and we have recently contracted to sell that land parcel to another party, and we received a token advance towards that, and once the transaction gets fully consummated, we will of course represent to you. But because we have received an advance from them, we have removed this 13-odd million square feet from the land resource. Yeah.
Okay, got it. Thanks for this. And the second question is on your pace of pre-sales. Is it fair to say that 750 crores that you have shown for this quarter is actually, represents underlying 2 to 3 quarters because, you had closed the sales and you opened it up in November and it's this Q4 as well. So is it the right way? And second is then how does it tally with your 2,000 crore, I guess, of net sale target?
So I won't say that would be the right characterization. I think in true sense, we were only shut for about 5 odd months, not even 6 odd months. And what we are representing is, not a pent-up sales. If that was the case, then in Q3 itself, all this pent-up sales would have emerged rather than in Q4. So we have also represented on the call itself that we see continued traction in April, and hence, we believe that going forward, this will be sustainable. Now, sustainable at 750 a quarter versus 500, 550 a quarter. As always, we would prefer to be a little cautious in our guidance and hopefully, I think, perform better than what our guidance is.
Okay, that's helpful. And you had mentioned earlier your unsold inventory of 15,000 crore. How does it stand now? I mean,
so now it would be down by about 1,000 odd crores.
750.
750, yeah.
14,3, 14,4, somewhere in that range.
Yeah.
Okay, got it. Thank you.
Thank you. The next question is from the line of Prem Khurana from Anand Rathi. Please go ahead.
Thanks for taking my question. Most of my questions have already been answered. Just one. So the 8,300 odd crore rupees that is due to DCCDL. So do we have any timeline in mind or in writing wherein, we need to give them the properties worth this much amount?
So we are in pretty active, discussions with GIC on these. And we honestly, hope to conclude the understanding, frankly, as soon as we can. But given some of the regulatory aspects, the actual transaction, while it may begin shortly, may end up consummating, completely in a period which could be 12 months or more.
Okay. So essentially,
part of it will surely get done.
Part of it will surely get done. You're right.
Part of it will surely get done within this quarter, but maybe a 1 or 2 may flow into the next fiscal year.
Okay, but then the properties would get transferred over a period of time because even if you start working now, it'll take you at least 3-4 years to complete these properties, which is how you would be able to give it.
No. I think you're confused over here. There are few properties which are rent yielding.
Okay.
And there are few land parcels. So I think we have highlighted that in a slide, slide 6. If you look at it, these are land parcels and also rent yielding properties.
Sure.
And obviously it will be a combination of two. In some cases there are regulatory approvals that are required before they get transferred to another entity. And that's what Ashok highlighted, that sometimes regulatory approvals take a little longer than what is envisaged. So we hope and expect that everything gets done within this current fiscal year, but there could be a one-off possibility of 1 or 2 getting into the next fiscal year.
But would they be open to taking land parcels? Because essentially, as you said, I rightly said, you are a DevCo and these are the RentCo. So would they be open to taking land parcels? Because ultimately they would have to come to you to get that done again
Yeah, so like I said, just to again refresh your memory, DCCDL in its existing form, legal form, has about 19 odd million square feet of development left in it.
Yes.
And they are already developing 2.5 odd million square feet.
Sure.
So the properties that we are talked about are again properties which are to be developed and held as investment properties, which is actually the business of DCCDL. Hence, to avoid any conflict of interest at a future date, it is advisable that these are transferred actually to DCCDL. They develop it and they hold it as investment property. However, if they want us to develop it and then sell it to them, that's a separate discussion altogether.
Sure. Thank you. Hello, I'm done.
Thank you. The next question is from the line of Kunal Lakhan from Axis Capital. Please go ahead.
Hi, thanks for taking my question again. Can you give a breakup of the 14,000 crore of inventory across, say, Crest, Camellias, New Gurgaon and rest of India?
Just 1 second.
About 6,500 crore is Camellias, about 3,000 crore is Crest, and balance is other properties across Gurgaon.
1 second.
Rest of India?
Sure. Just 1 second. We just reconfirming the numbers for you.
So about 6,500 to 7,000 is Crest and Camellias combined. So that was my marginal error. About 3,000 is rest of India, which is the non-Gurgaon, and about 4,000 plus is all of the rest of Gurgaon properties, including some of our older plotted developments.
Sure. Secondly, again, just to probe on the guidance, see, I just want to understand, like, when you're giving a guidance, obviously you're being a little pragmatic also. Like, I wanted to understand what's the state of demand that you're looking at, because we're looking at ready inventory without GST burden, without execution risk, and we're still giving a guidance of about 2,500, which will take maybe 6-7 years to monetize our existing inventory. How should we look at the state of demand that you are factoring in?
That is if you're assuming that you're straight lining 2.5 and dividing that by the inventory number. We never said that this number will not move forward. All that we are saying is that at this stage where we are sitting, we are guiding to a number which is on a steady state basis on a net sales of about 2,000 to 2,500 crores. We will be, of course, updating the markets on a quarterly basis as to how this dynamics changes. That's what I'm trying to highlight. So I'm not saying that I'm giving you a steady state guidance of 7 years over here. Don't extrapolate it to that.
But over a period of 4 to 5 years, will we be looking at monetizing this ready inventory?
If the markets are healthy, why not?
Why not even earlier?
So, I think one important point is that hopefully with the capital actions, etc., the residual taking care of the net debt as it exists today, and with the pending receivables taking care of, in fact, more than taking care of the pending construction liabilities, in some sense, we need to continue selling them at the right appropriate value. Hopefully the pace of sales will pick up. But in all fairness, let's face it, once all of these issues are resolved by the end of the year, honestly, there's no tearing hurry for us to try to sell 6,000 crores in a year, frankly. We'll obviously ensure that it continues selling, and this, as Saurabh mentioned, 2.5 is the guidance we are giving for the ensuing year. There's no reason to believe why it should not pick up in the following years.
Also, I want to highlight something. If you look at that page 10, you just asked how much is inventory left to be sold in Camellias Crest. If you look at page 10, we are actually further diversifying, and this is just right now the first set of indicative projects that are there. But we are diversifying our geographic risk. So, the DLF Urban project or Midtown project in Delhi is a Delhi project. It's not going to be Gurgaon. So, in 2 to 3 years' time, it will start adding to our sales numbers. In case of HSIDC, it's a commercial, while it may be in Gurgaon, but it is commercial, it's not residential. And the dynamics of commercial is very, very different. So, if you were to look at, I would say the 5-mile radius from Cyber City, today where we are sitting, there's very buoyant demand for commercial space, by high net worth individuals who are looking at buying property, and we have experienced that in Horizon Center in DLF 5. There's no reason why we cannot replicate that in Cyber City. And the last, of course, is the New Gurgaon, which is again commercial, where we are in dialogue with a large bank to actually build a kind of a campus for them. So it's not something which is where I will build and look for a customer. Here, we are already in dialogue to contract with a customer, and then we start to build out for them. So these are pretty much in the bag, and if you were to impute value on these, you are actually creating inventory northward of 20,000 crores for DLF's share as such. So just to highlight that as the old inventory starts to come off, there will be new inventory, and that as a combination on a debt-free environment becomes the proposition that we want to highlight.
Sure. That's helpful. Thanks so much.
Thank you. The next question is from the line of Parikshit Kanpal from HDFC Securities. Please go ahead.
Yes, so just continuing on HSI, so what could be the configuration here in terms of size of offices?
It's too early to say. The total development potential is about 2.5 odd million square feet. Obviously, it will go through a designing phase, and they will of course, there are apparently 2 or 3 towers that are going to get built. So very difficult right now at this stage to give you as to what the configuration of the floor plates would be.
But total sellable here will be 7,500 crores, total sales potential. So the ticket size could be like 10 crores, upwards of 10 crores per unit, or?
Don't know. I mean, in Horizon, which is the comparable product, the ticket size is in the range of 30 crores. But, honestly, since we do not right now have the configurations here, I think it will be very speculative for us to comment on this.
Yeah.
Okay. And in this developments like HSI, so this DCCDL cannot buy here, right? They'll not be interested in this kind of property.
They can always be interested.
That's a discussion which once, if and when we have the discussion, we'll let you know. But
so I think what I have highlighted in our presentation is that B2B opportunity always exists. Okay. Right? So tomorrow, DCCDL may come and say, hey, why are you selling it to customers or retail customers, if I may say, on a strata sale basis? Why don't you sell the whole project to us after you complete it? Yeah. Absolutely. We will look at it, but please do realize that we are 67% equity holders of DCCDL, so we will of course also look at what our opportunity over there at that point of time is.
Right. Okay, sir. That was from my side. Thank you.
That is my B2B sale, actually.
Okay. That's all from my side. Thank you, sir. I just had this question.
Thanks.
Thank you. The next question is from the line of Puneet Gulati from HSBC. Please go ahead.
Yeah, thanks. Just taking on from there. So how you are probably the owners of, actually the owners of both DCCDL and DLF. So how do you decide what gets sold where?
I don't decide. I offer. GIC has participative rights. GIC eventually decides on the price of it, and that's how the deal gets concluded.
Okay. Second question is with respect to the 8,300 crores of payables. Does that mean the entire rent yielding assets of the DLF group will eventually move to DCCDL?
Yeah, the short answer is no, but again, right now, frankly, since we are in the throes of discussions with our partners, we would honestly not want to get into the complete details of which specific asset has a higher probability of being transacted and which not.
So why I said no is because the headquarters of DLF, which is DLF Center, will not get transacted. We want to highlight from that perspective.
Okay. So balance, just trying to understand, are all these assets worth 8,300, or you'll have to give more land along with it? So how does that valuation work out roughly?
My submission, wait for a few weeks. Hopefully, once we have our agreement, we'll share it with you.
Okay, simple question. What is the rent from all these assets so far then?
Okay, good point. So the rent on the DLF side is about 500 crores a year. Of really rent-generating assets as they are right now, which is expected to grow to about 600 in the following year, because Noida and Saket are both, hopefully looking at a rent increase.
Okay, that's great. And last question, how much receivable is left from the, from what you've already sold?
3,300.
3,300. Okay, great. Thank you. That's all from my side.
Thank you. The next question is from the line of Rafael Fu from Target Asset Management. Please go ahead.
Hi, hello, hi. I think just following up on my question on Bangalore, I just wanted to ask, does the monetization of your Bangalore land bank indicate your plans for the land bank? Are you planning to sell more of your land bank? If you can share something around that.
No, this is basically very opportunistic. It was something which was not part of our next few years of development. As I was actually highlighting before, I think your line got cut off. It's a land bank that we bought about 40, 50 years back. So, and it is pretty much distant from Bangalore. So hence, was not part of our plan as such. We got an offer from a buyer, and hence we decided that we will explore the possibility of taking an advance from the buyer. And hopefully, I think once the transaction gets concluded, we will inform the markets. But you are absolutely, just want to highlight this aspect is that we are always continuously looking at how to enhance our land. So we do keep, buying and purchasing small parcels of land. But this is not indicative of our strategy to monetize land bank. No, that's not what it is.
I see. Okay, all right. I because I do recall, I think 1 or 2 months ago, there was some articles that were talking about that I think DLF is going to share what they plan to do with the land bank. So this is not part of that plan.
Yeah, so that was a Bloomberg, I think, blast, which unfortunately, when they've just described only few words over there, doesn't convey the full meaning. By monetization of land bank was how is your development business going to pan out over the next 4 to 5 years. So that was actually, what we had guided and we had discussed, but the headline was how will DLF monetize land bank.
I see. Okay, all right, thank you. That's all from me.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Ashok Tyagi for closing comments.
Okay. So thank you so much for, being on this conference call for the year ending. Just a couple of directional points, some of which are observations from the call itself. Firstly, I would like to reiterate that just because we now own 67% of Cyber City and no longer 100% doesn't mean that it is no longer the biggest part of our operations. Cyber City is the biggest part of our operations. It continues to be, a huge part of our time and effort continues to be to drive the growth in that business. It's just that it is no longer going to be combined line by line, but on a single bottom line basis. So, just as an example, in Q4, 1,250 crores of revenue and 790 crores of EBITDA, which would normally have combined line by line, is absent, and, it's a single line 205 crores. So it's not some JV from some money from profit share from a JV in Botswana. It's actually right in our core operations. That's one basic thing. Secondly, Saurabh did sort of reiterate that hopefully the capital actions should take care of our net debt. And as we have seen the traction and the revival of our pre-sales process, and hopefully, in the next quarter or two, we should be able to iron out any residual issues to sustain that momentum. We believe that we are hopefully, geared well for coming out of this consistent cash deficit cycle that unfortunately we had earlier, and pretty bullish that by the end of March 19 we should be okay. On the EBITDA piece, I think, I know that we couldn't give you a complete firm guidance, but I think there is this entire spectrum of the new accounting standard, and if it comes the way it is right now, it will lead to a significant strengthening of go-forward EBITDAs, and hence, we are just waiting for how this entire thing pans out in the next 3 or 4 months. Our core land banks in Gurgaon, Delhi, etc., continue to be fully approved. We are investing tons in infrastructure. In places like Gurgaon, we are getting additional FAR on account of TOD, etc. So all in all, after a lot of quarters, I think we do believe that we are getting to where we had, originally intended us to be. It may still be a couple of quarters with, some minor bumps before we are firmly in the saddle on that. But we do believe that I think today, post Game Changer, post the revival of some of the pre-sales, the trends that we have seen, I think we should be moving in the right direction. So with that, we'd like to thank you.